Okay, so in the short break, I didn't actually take any tea. I was moved by AA's contribution, so I went to look for that past question that tested practically that question AA spoke to. So let me stop sharing my screen and maybe just project that. Let's look at that Pathfinder briefly. Okay, so it was the November 2016 paper, and the examiner tested requirement 1 and 2 fully. There was no financial statement analysis. It was purely capital reconstruction. In fact, it was a special diet. So you can see the requirements on the screen. He said recommendations on how to reconstruct the company's capital, including capital reduction if necessary, so as to bring the company's capital in line with the fair value of the company's asset. You should also outline the steps with the fair value of the company's asset. You should also, you should also outline the steps the board will take to successfully carry out the exercise. You see, they are asking you for the computation now, requirement 1. Then requirement 2, a brief discussion on benchmarking. Okay, so this is a strategic management tool now. So they're asking us to use that tool to speak to the improvement of corporate performance. We should talk about the types of benchmarking and which type the company should adopt. Also, the steps necessary to carry out a successful benchmarking and the benefits the company is likely to derive from the exercise and the possible limitations of benchmarking. So it's another topic in business analysis, benchmarking, but expressly he tested that capital reconstruction in requirement 1. So you can see the exhibits, and this is the SFP where you need to perform all the computations. So I'll suggest that we go back and look at this diet. It's good. Go back and look at this diet and try to prepare a formal report. I think the next topic we'll be taking after this next past question is business analysis, chapter 5. And that's where benchmarking is. So AA just asked the question that needed. So this is the only diet he has tested capital reconstruction. And this is a long time, November 2016. So we don't know if he will bring it on November 2025. So you don't leave any tables unturned. Anything is examinable under ICAN. And even though the pre-scene will come, we also need to be aware of any areas and be also prepared, not just awareness, but preparedness to ensure that any area examinable or tested, we are ready for it. So please, have a look at this illustration at DEX. There's another illustration as we continue the lectures, 2 illustrations in the study pack. Please, I'll suggest in your practice, in your reading time, go through that November 2016 requirement 1, write the report, and if you can, send it to me based on the 8 boxes. Send it to me, I'll mark it. If you can't, no problem, but make sure you have your hands on the calculation and have an understanding of what the scheme is. Even if it's not examinable, you've still added to knowledge, your knowledge bank. Very important. Our learning curves need to go up every day. Some of these things, you may not need them for ICAN exams, but you need them in the office. You need them in practical day-to-day activities you meet with your clients, meet with friends, business, and all that. So if it resonates with you, you'll be able to provide context and you're able to share, bring light to somebody's darkness someday in this area practically. Okay, so once again, thank you, AA, for the engagement, and that has asked me or sprouted me to go back and look at where that question is. So November 2016 is the question, and that's the diet tested capital reconstruction. All right, so let's get to work. Going back to where we stopped, we're speaking to the steps, and we said the areas of capital reconstruction and the coverage, the cover the law provides to creditors, and also the areas of reduction to continue the business, or reduction or in settlement of a liquidation situation of a business. So we'll be speaking to those thoughts, or we'll be continuing that conversation around the ordinary share capital reduction. And you look at share premium, usually the first to be written off. Okay, yes, please. I can see AA's hand up. AA, please go ahead.
Sorry, sir. I just want to get something now. The question you just shared now.
Yes,
It's
please.
The requirement 2 does not relate basically to the 8 boxes. Does it mean we are not going to use those 8 boxes to answer that?
Okay, fantastic question. So every question in the ICAN case study, past question, future question, as long as the examiner has not changed it in any syllabus review, must follow that structure. It must follow the 8 boxes. So if you look at the second question, or the second requirement, a brief discussion on benchmarking as a strategic tool to improve corporate performance, types of benchmarking, and which type the company should adopt, the steps necessary to carry out a successful benchmarking, the benefits the company is likely to derive from the exercise, and the possible limitations. Now, in using the 8 boxes, let me run you down through how I will answer this requirement too. So from the information, I'll read the exhibits, then I'll first take data and information and explain benchmarking. Or I may not need to explain benchmarking in data and information. I may take generally the exhibits and talk about how the organization has performed. I will not talk about the need. So I'm using data information to talk about the corporate business performance. So if I look at 4 parameters, looking at their trajectory, their antecedents, I've gotten 4 superior achievements for data and information. So I may not look at benchmarking. Then when it comes to the second box, professional tool, that is when I now speak to the types of benchmarking, because benchmarking is a tool, is a strategic management tool. Don't forget. So it's not all computational, maybe ratios, MPV that are tools. No. SMTs and PMTs are tools. SMTs are strategic management tools. PMTs are performance management tools. So strategic management tools, benchmarking is one of it. So in professional tools, I'll talk about benchmarking and how it relates to Julie's Engineering Company Limited. So you see, I've spoken about professional tools. Then in analyzing your analytical skills, box 3, I'll now analyze, based on the benchmarking tool, how Julie's industry has performed, benchmarking it with peers in that industry, if there is. And if there's none, I'll just speak to how it's supposed to benchmark. So I'll analyze benchmarking in relation to Julie's Engineering and how it could employ that tool to benchmark its way to increase stakeholder value or maximize its wealth. So you can see I've analyzed benchmarking in relation to the third box. Then challenges and consideration, the fourth box, issues and options. Of course, there are definitely limitations based on what Julie's Engineering has gone through. I'll just state them, 4 of them, and explain. So you can see the boxes. We follow them the way it is. So there's a format in the Pathfinder. Look at the box. It's just that I didn't explain what the box is. Let me share my screen again so that it will provide context for us when we practice. Okay, I believe you can see my screen. Please confirm you can see it, please.
Yes, sir.
Okay, fantastic. Okay, so let me run to so if you can see this area of the boxes, you see the data and information now. You don't need to pick what is directly on benchmarking. You can use information in Exhibit 1 to explain Okay, no, okay. This is requirement one. I beg your pardon. This is requirement one. Let me go to requirement two. Okay, so this is requirement two. Requirement two spoke to benchmarking. Now, you can use information in Exhibit 1 relating to the case to speak to benchmarking, or requirement 2 that spoke to benchmarking. Then you can use information from Exhibit 2 in the letter. So you see the examiner has given you a clue on what to speak to. So you see professional tools, you need to identify benchmarking as a tool. You see these points will help you to write. So use these headers. It's just that you cannot use professional tools and knowledge as your own header. You have to have a point, like I've said over and over again. Use what resonates with you. Don't by any point use, because this is what the examiner uses to mark you. And if you use it, it shows that you don't understand case study. So following these points will help you write based on the case study. You can see the 6 boxes. You see it: analytical skills, 1, 2, 3, evaluative skills and judgment. It even give you conclusion and recommendations on how to write the report. So you see, mostly he gave more than 4, which is superior achievement, competent achievement, below competent achievement, no competent achievement. So this format should be followed for every case study exams. Requirement 1, requirement 2. Whether there's computation or no computation, there must be a tool you use to either explain or calculate. Yeah. So good question. In fact, AA's questions are very practical. Thank you for bringing them up. And I hope that provides clarity to what your concerns are.
Very well, sir.
All right. Thank you for bringing them on. I appreciate your questions. Very good ones. Okay. So going back to our conversation on ordinary share capital, we said we're reducing capital and share premium is the first. Share premium is the first. So going back to our conceptual understanding of share premium. What is share premium? What does it mean? Maybe we've forgotten. What is share premium and why is it the first to write off during a capital reconstruction or capital reduction scheme? Very important. So we need to understand these things pragmatically, so that in applying them during maybe computations, we'll be able to understand why, not just maybe memorize a format. We should be able to understand why we need to do what we are doing. So we said share premium is usually the first to be written off. Why and what is even share premium? So in my own understanding, share premium is the amount a company receives from issuing shares above the nominal par value. What does that mean? Above the nominal par value. So a company issues shares at a nominal value of, let's say, 1 naira each. But at the end of the day, sells them for 5 naira. You see, that extra 4 naira is recorded in the share premium account. And this account is part of the shareholders' equity, but is restricted. You can't normally use it to pay dividends because it's not distributable profit. So that's generally the concept behind share premium. I believe I'm reminding us of our financial reporting or currently our SBR concepts. Okay, so why is it also necessary, or why is it usually the first to write off in a capital reduction or arrangement, capital reduction arrangement? When a company wants to reduce its capital, actually accounting and corporate laws in many jurisdictions, in fact, including UK companies, and we have similar frameworks in Nigeria, it requires that capital reserves such as share premium are reduced before touching any components like paid up share capital. So the reasons is because the least impact on nominal capital is one of the reasons for writing off share premium first. You see that the nominal share capital is legal, is the legal capital. It protects creditors, and the law often requires this to be preserved unless necessary. So the paid off capital or the nominal capital is the legit capital. It's not that share premium is not legit, it's already a surplus over the nominal value. So reducing it doesn't really directly alter nominal capital. So that is why you write off that first. And it helps. One of the reasons is also a cleaner balance sheet first. When you write off share premium, it reduces capital without affecting the number of shares in issue or their nominal value. So it's administratively simpler and makes sense. Another reason is the legal order of reduction. So many jurisdictions, UK, US, specify that if you are cancelling capital losses or returning surplus capital, you must first use share premium, that's the surplus, then capital redemption reserves before reducing the nominal share value. So I just needed to provide context to that so that we can get it clear. Okay, so preference shareholders and their par value often remains the same to protect their dividend rights. Preference dividend is deducted directly from profit after tax before even distribution to shareholders. They must get their dividend first because it's a covenant. And that is why when you are calculating your earnings per share, if there are any preference dividend, you must deduct it from your profit after tax first by the number of ordinary shares. So preference shareholders are treated specially because they provided you external capital, must honor them first. Okay, so that will be the end of capital reduction, and I think we've shed much light on that. Do we have any questions so far? I think we are running to the last part of the lectures. Any questions, contribution, observation? Okay, fantastic. Anna is just quiet. It's only me and AA that are engaging. Is Anna there? Anna, are you following? I hope she's there. You're muted if you're speaking. Let's believe she's there. All right. So we're looking at capital reconstruction now. This scheme of arrangement is applied when a company is in severe financial difficulty and needs to reconstruct its financial position. It often involves also capital reduction. So all these schemes are interrelated. Like A asked a question, how are these, when we're speaking to reorganization, how do they relate? So three of them, reorganization, reduction, reconstruction, they actually relate, especially in practice, in process, and in their in the actual act of their computations. So you can see that capital reconstruction involves also capital reduction. It involves capital reduction too. All right. So since it involves capital reduction, what is capital reconstruction? Let's even understand that word or that phrase. What does capital reconstruction mean? It's also a form of capital reorganization, but it's where a company restructures its capital base. Like three of them, the other two we've looked at, often also to deal with accumulated losses, improve its financial position, or make the capital structure more efficient without necessarily closing down the company or going into liquidation. So typically it involves rearranging the rights, the values, or amounts of share capital, reserves, or debt to create a healthier balance sheet. So what is the purpose Why capital reconstruction? So like the other ones we've looked at, is also the purpose number one is to wipe out accumulated losses so the company can resume dividend payments. Accumulated losses in terms of negative retained earnings could, in fact, most companies cannot pay dividends. And shareholders actually desire dividends. Most investors desire dividends. So this could be a reason or the purpose of capital reconstruction. Another reason is, or the purpose is, to reorganize debt and equity to reduce interest or debt obligations. This is a reason that was spoken about in the capital reduction scheme also. Another purpose is to return surplus capital to shareholders. We saw that also in capital reduction, if the company has more than it needs. Exactly. Another one is convert debt into equity to reduce gearing. We saw that in capital reduction. Then one that was not in capital reduction is you can reconstruct to facilitate mergers or acquisition with a cleaner capital structure. Yeah. So the common methods, of course, capital reduction is a common method of capital reconstruction by reducing nominal share value or canceling shares to write off losses. Then capital consolidation or subdivision, like changing the nominal value. For example, you have 10 shares at 1 naira each to 1 share of 10 naira each. You can reconsolidate or subdivide a share like that. Then the conversion of debt to equity. You can turn loans or debentures into shares with the agreement of the external providers of capital. Then another method is the alteration of rights, like changing of voting rights during AGM, dividend rights, or preference terms. Preference terms could be changed to loan stock, like we saw in the capital. So some of the examples in the capital reconstruction reduction resonate with the reasons or the need for capital reconstruction. So it's also an alternative, like we said, to liquidation. And the asset value may be less than the liabilities, and that is why you need financial restructuring. So where liabilities are more than the asset value, capital reconstruction is needed. It requires agreement also with debenture holders and creditors on liability treatments and agreements and changes to facilitate and foster the long-run survival and sustainability of the business. Also, the need to achieve economic viability and profitability is also one of the reasons for capital reconstruction. It may involve raising new capital, like I said, under capital reduction rights issue, after writing down capital to make shares or the company's shares more attractive. And also removes losses from the statement of financial position for earlier dividend payment, like we saw, where a company is bedeviled with accumulated losses. Then we have the types of capital reconstruction. We have the internal one. Internal reconstruction speaks to no liquidation. No liquidation. A company is not shutting down or liquidating. So internally, we are restructuring to facilitate the going concern of the business. While we have external reconstruction, where a new company takes over or the same company winds up. That's what it means. So internal, the company will continue as a business, but external, a new company takes it over or it winds down and distributes its assets, settle its debt and obligations, and ceases to be a legal entity. Okay, so let's look at the capital reconstruction scheme. The capital reconstruction scheme is the only alternative to liquidation in severe distress, especially the internal one. And the liquidation outcome influences the scheme's design and the scheme's evaluation. So where you want to internally restructure, that's an alternative you're looking at, than liquidating. But where the internal reconstruction will not change things around, that the business has to go through an external reconstruction, which speaks to liquidation and the process of distribution of the assets to different stakeholders of the business. Okay, so the distribution in the area of liquidation is an area we want to look at. The distribution of the assets, especially where an external reconstruction is agreed on. A liquidator is appointed. A liquidator is someone that the court approves based on karma to mediate between creditors and the company in the settlement of obligations. So a liquidator, and often there's also who is called a receiver, is appointed to sell assets and pay in this order. So the first order in the situation of external reconstruction is fixed charge debt. Fixed charge debt. So after the sale of the assets of the company, and a receiver often is appointed, like I said, the deficiency treated as unsecured creditors are paid to fixed charge debt holders. So the fixed charge debt holders receive the first proceeds first before the unsecured. So the fixed charge are secured before the unsecured debt holders. Then we have the liquidation costs that must be paid first. The cost of processing, the liquidation, the cost of court orders, papers, secretarial expenses, and all that must be paid after fixed charge debts have been paid. And in the event of liquidation, the preference creditors, based on the Insolvency Act of 1986, Schedule 6, speaking to payee, VAT, pension, employee pay with limits, they are actually unsecured, but following this order, they have to be paid. So these expenses, as accumulated by the business, after preference shareholders, creditors have been paid, all these expenses, if pending, must be paid based on this Insolvency Act. Yes, please, AA, feel free to interject.
Sir, looking at this list now.
Yes, please.
Where would the trade creditors be? Is it more like the fixed charge debt or what?
Okay, very good question. So fixed charge debts are not creditors. So trade creditors are day to day. That is within 1 month to 12 months. So trade creditors are normally between that range, except carry over into another year. So fixed charge debts are those like debentures, bonds. They have fixed term. Trade creditors don't have fixed term. So trade creditors will come after all the external creditors have been provided. Then before shareholders, you pay your trade creditors. So trade creditors must be paid, but they are not the long-term creditors. They are short-term. So after you've paid long-term, you pay short-term, and the proceeds will be distributed to the ordinary shareholders. So trade creditors will come after the long-term creditors have been paid.
All right, okay? Thank you. That's the unsecured creditors, basically.
Yes, unsecured creditors, yes. Correct. You get that correct. So they are unsecured creditors, but you must secure their money before even shareholders, because they've provided you with day-to-day stuffs to run the business. So they must be paid, even though they are unsecured, but they will secure their money. All right. Thank you for that clarification. Okay, so floating charge creditors also, speaking to debt charges that are floating. So what are floating charge creditors? We need to understand that. What are floating charge creditors? So when you say floating, You look at something that is it hanging on the air? Yeah, it sounds like that. But then when we use such terms in accounting, it helps to provide context and give you a picture of how it looks like. So a floating charge creditor is like a lender or a creditor whose loan to a company is secured by a floating charge on the company's asset. So he has a charge on a particular asset. So that floating charge is a type of security interest that floats over a pool of changing assets. So they could be trade creditors like AA pointed out. They have a float on stock, receivables, raw materials provided to that company to manufacture. So the company can sell, the company can use or sell or replace these assets in the ordinary course of business without needing the creditor's permission. Now that his charge crystallizes or turns into a fixed charge when a specific event occurs. Like, okay, you default in paying him. So in a situation like insolvency or liquidation we're looking at the appointment of a receiver, the floating charge must be paid. He holds a floating charge. So their security ranks below the fixed charge actually. And when assets are distributed, they will be paid. So for example, a bank lends 200 million to a manufacturing company, secured by a floating charge on the inventory or account receivable of that company. So you can see that that bank must get its 200 million and the floating charge is on the inventory. So whatever it is as inventory balance that is unsold can be written down at based on IAS to the net realizable value. The net realizable value could be sold of that inventory to pay off the floating charge. So that's generally what floating charge creditors are. Then the unsecured creditors, like AA said, are those from the trade creditors. So they are also including those from deficiency on 1, 2, 3. Even though those are secured, if the company is deficient and has not paid the 1, 2, 3 people, you must pay them under the unsecured creditors, which includes the trade creditors. Then finally, the shareholders as per the articles. But you see, preference shares will also come before shareholders. Those ones have a restrictive covenant. It's a restrictive covenant, so they have a fixed charge. You must pay them before shareholders. So the shareholders comes last. And under your equity, preference and ordinary shares come together. You don't post preference shares as long-term liabilities. It comes as equity. Preference is also an equity. It's very important you take note of that. So if there are insufficient funds during the liquidation process, if there are insufficient funds, each member will receive a proportionate amount where maybe the ordinary shareholders will not get anything. So the fixed charge will be prioritized. That's what we mean. They may not get everything 100%, but they shouldn't be left worse off. So if the ordinary shareholders are not getting anything, the distribution will be prorated based on the order of priority and their weight of investment in the company as the law permits. So that's the situation of liquidation and prioritization. So I'll suggest you go through those examples and look at practical scenarios like we've seen in our deck. We'll look at another example. Then that November 2016, please do the computation in requirement 1 to understand the dynamics of computing all these amounts in case you have a scenario in future or in the November 2025 exams. All right, so let's look at, as we round up, designing a capital reconstruction scheme. Designing a capital reconstruction scheme. The objective is to create a profitable going concern, especially for the internal. And also the external, maybe a company is buying it over, not it winding down totally. The objective of every capital reconstruction scheme is to create a possible going concern. Then the severe difficulties may make this objective impossible, but less severe issues have higher success probability. For internal reconstruction. And usually it requires relieving immediate debt burden and raising new finance or share issue to make the business continue. Then affecting creditors, shareholder rights require necessary vote majorities based on the KAMA and a court sanction. So most reconstruction schemes need court orders, and the law needs to guide how those processes are carried out. And the scheme must give each party at least what they get in a situation of liquidation, and they may not get what they've provided for the business, but at least they will get something and not be worse off than when they invested in that business. Worst case scenario in a liquidation situation. Also, they must be given fair hearing and equitable distribution, and they will treat all classes of creditors fairly. That's typically what a capital reconstruction scheme speaks to. Also, the combination of capital reduction, capital reorganization, capital reconstruction to write off losses, write down assets is what the scheme should be designed to do. And in writing down these assets, they need to help the creditors and the shareholders at least have some proceeds is the objective. Then in evaluating this capital reconstruction scheme, the aim is to establish relative fairness and equity of changes in those rights, whether internal or external or a liquidation situation. So professional advisors often evaluate for each class in the area of liquidators, receivers, and valuers are employed to do this independently and objectively. It requires evaluating the whole scheme as a whole due to changes in relative rights, speaking to capital repayments and income participation. So what most big companies do is they employ big four firms, and some of the big fours have departments that specialize in liquidation and reconstruction. So they employ those professionals to come provide their expertise and judgment in this scheme of arrangements. So they also compare interest of parties before and after the construction to provide fairness in their distribution. So the second question, like I spoke to, the first one was ADEC. The second one provides a clear picture of how to demonstrate, or the TADEX PLC question demonstrates evaluating a proposed scheme by comparing liquidation outcomes before and after the scheme with potential future earnings under different scenarios. So look at that second question under the study pack, crunch the numbers also so that you can gain or glean understanding of what we're speaking to. It also considered the impacts on banks, debenture holders, trade creditors, preference shareholders, ordinary shareholders. The goal is for all parties to benefit, or at least be no worse off than in the liquidation to gain their agreements. So that's generally what the capital reconstruction, internal and external, speaks to. All right, so that will be the end of chapter 4. And we're landing or ending this chapter before 9 o'clock, which is good. So we have 5 minutes to maybe discuss anything of importance or any questions, contributions, observations on financial restructuring or capital reconstruction we've just looked at. Any questions? Any contributions, even though the conversation has been enriched by a lot of questions and interjections by AA, and I really appreciate the engagement. It was resourceful. Questions were practical and they resonate with the subject we spoke to practically. So any additional questions? And we've ended chapter 4. So we'll be moving to chapter 5 after we've looked at the past question on March-June 2020. And we'll look at the past question. We'll move to chapter 5. And we need to run fast. We are in August. So hopefully before the end of August, September, we should round up with lectures. And we'll now face reading and practice practically. So we could be prepared and also have mock exams to help us stay ready for the pre-scene and the case study paper proper. Okay, so like I suggested, please let's go back to those two questions, ADEC and this other one that TADEX, 2 questions in the study pack. Let's crunch them, then also go to the November 2016 and try the reports. Let's look at the reports and write around those boxes. Okay, I think AA is the only one on the call remaining. NA has left. All right, AA, do you have anything to say so that we can shut down? Any contribution? Any observation?
I